Hi, everyone. This is DeFi Dad. Welcome to episode 2 of Yield TV. I'm excited to have Keegan Selby joining us. Let's kick this off. Well, that's good. I think I was muted there. So that's a great way to start the episode 2. So, hey, everyone. I'm DeFi Dad. Welcome to episode 2 of Yield TV. I've got the managing partner and co-founder of Fourth Revolution Capital, 4RC, Keegan Selby, joining me today. We're going to talk a bit about the DeFi market and some of their theses at 4RC. I've known Keegan for about 6 months. We met through some friends and found out we have a lot in common in terms of how we think about the DeFi markets. So I think he'll have some interesting, fresh takes for us today. So how you doing, amigo? What's up?
How you doing, my man? Thanks for having me on. I'm excited to be here.
Awesome. And let me check the comments here. Make sure. Can everyone hear us? I love, like, I had like a little prepared script there to be like, hey, everyone, welcome to Yield TV. And I'm muted. So typical stuff. Awesome. Okay, cool. It looks like we're good. Please comment if you guys have trouble hearing us at all. So Keegan, why don't we just start with your background? Tell us more about your career, how you decided to raise this fund to focus on DeFi, and just how do you guys think about DeFi at 4RC?
Yeah, I would love to. Cool. So thanks again for having me on. So Keegan Selby here. So I started off in engineering. I studied aerospace engineering at USC with a minor in entrepreneurship. I worked at Northrop Grumman on like a top secret F-35 fighter jet program for a couple years. That was really cool. Eventually sold out to work in traditional finance. If you've seen the movie The Big Short, the CEO and founder of the company I worked at, he bought the New Century servicing platform out of bankruptcy. And that was kind of featured in the movie. Then he built this massive kind of $100 billion asset manager around the mortgage and mortgage credit and real estate space. So I worked there for a number of years, kind of in kind of secondary markets, securitization, kind of getting my traditional finance chops all squared away. I got into Bitcoin kind of 2011. I saw the What is Bitcoin YouTube video, that really cool animated video. Was kind of just like mind blown and was like, this is going to be the coolest new thing ever. Really ramped up investing for like 2013-ish. Once Ethereum hit the scene, I really was like, okay, this is going to be eventually going to be my career. I think this is like definitely turning into more of like more than like a passion, kind of investing in a stock market kind of side hustle thing. And now with kind of the advent of DeFi, just, working firsthand in the mortgage space, I even had to get my kind of mortgage originator's license. So I've seen all the fintech, and I worked in building a lot of the fintech solutions around that space. And I've just kind of seen the latency and inefficiency and the amount of fees that go to middlemen. One of my favorite examples, like one of the easiest persuasions that I can say, like, hey, DeFi has value over TradFi, is if you look at like just the savings rate for like a Chase bank account, it's 1 basis point. It's 0.01%, right? And I personally earned via Compound, via Aave, and solutions like Cream and different borrow and lending money markets. I've earned like 10% in DeFi on stablecoins, on dollar peg stablecoins. So that's 1,000x improvement. So that to me, so once I started kind of seeing these money markets go live, I invested in like a lot of the 2017 ICOs, like hopefully just like covered the gambit there. And back then it was like investing in like white papers and PowerPoints and stuff, like these weren't real products. I got lucky, a couple like big hits like Chainlink. I'm super early into Chainlink and made a ton of money there. But for the most part, all those projects, like a lot of startups do, they died or they just were abandoned or whatever. Or the idea was kind of, too early for its time. So like these like grand ideas, like revolutionizing healthcare and bringing like identity to every person in Africa and like all these awesome, like grandiose visions were great, but they were just like before their time, but DeFi is actually, it's different. It's the first kind of killer application of cryptocurrency and blockchain technology and DLT. It's live. There's, $10 million of value locked in these smart contracts. So it's the first like real cash flowing use case where you can actually look at it from like, you can apply traditional valuation methodologies like DCF and PE ratios and everything else. And you can start to evaluate some of these projects. And rather than just like, oh, I think Chainlink's going to be, a $50 billion market cap one day or whatever, you can actually look at some of the cash flows and come up with a real valuation. So that's when I got really excited. That's when my partner, EJ Rogers, and I decided to leave our jobs at our traditional finance asset manager and go full time and launch this fund. And we're really excited. So we're kind of in stealth mode right now. We haven't launched our website or anything, but there's going to be a lot more details. We're going to put up a Medium post introducing the fund and everything shortly. We're in the middle of our cap rates right now. So
that's really exciting. You guys have essentially been full time. It's just that it was, having to work through the nights outside of your day job. So it's cool that you can finally focus on it. What do you think is a light bulb moment for those that you have raised funds with? Like when do you see their eyes light up and they realize, hey, like, oh, this is something I cannot unsee and I want to participate in it?
So when I pitched my LPs, we had this super fancy deck that I wish I could just like post on Twitter, but of course, marketing, funds and everything, it's illegal. So can't do that. But when I pitch LPs, I like to just run through the deck. I talk about kind of the core advantages of blockchain technology over kind of traditional ledgers and, traditional servers and IT systems in general. And then I talk about kind of cryptocurrencies and DeFi's advantages over traditional finance, that, the money Legos, and this is modular open source code that we can build these brand new financial primitives, and it's awesome and exciting. It's accessible to anyone in the world with an internet connection or a smartphone. It's low cost. We're disintermediating all these kind of institutional middlemen like Chase. So, if you're a borrower and you're paying 5% as a depositor, you're probably making like 4%, which is, like I was saying earlier, it's like 1,000x improvement over today where you're a depositor at Chase and they pay you 1 basis point, 0.01%, kind of ridiculous. So I like to actually, like I was saying, so I run through that deck real quick and then I actually demo the live platforms. I'm like, hey, this isn't like, these aren't white papers or like kind of pipe dreams anymore. These are live protocols. Like there's websites that we'll show you right now. So I hop into things like synthetic exchange and I'm like, hey, we now have like synthetic representation of equities, of Forex, of commodities, of crypto, where you can go long or short, where you can trade options, where you can actually submit your own options. You can, soon we're going to be able to trade futures on synthetics. And they're like, okay, so now anybody in the world can, short or go long on like a Tesla stock and also gold and Japanese yen, or maybe an index like the DeFi, the SDFi index. And they're like, well, that's new and really badass. And the fact that in DeFi, you can actually invent new financial instruments to trade on top of synthetics, or you can copy and paste kind of their staking, like incentive, that whole smart contract, and you can create a brand new protocol that kind of edits one parameter of the code and launches kind of a new use case. They see things like that. They see kind of the money markets for borrowing and lending like Aave, some of the cool new ones like Cream. They think like they see like the stable coins, like the classic. You always get the, well, why would anybody ever use Bitcoin to like pay for coffee? And it's like they wouldn't. Like that's not a great use case for Bitcoin. But now we have these things called stable coins that are pegged to the euro or the Australian dollar or the US dollar or whatever, the yen. And you can actually have kind of the payments use case accommodated. So those are kind of the big light bulb moments that when I actually start showing them the product, that this isn't some future tech that it's like seed funding or whatever. This is real. This is wild and live today that you can use.
I know recently I had never borrowed with Aave, and I had opened up a vault before with MakerDAO. So I deposit Ether and I borrow DAI against the value of my Ether. It's a very standard thing. It's the original DeFi of DeFi.
Yeah,
but when I tried Aave, I deposited 4 different types of collateral. It was Wi-Fi, wrapped Bitcoin, Link, and Lend. And I did not realize that you could do that. Like as far down the rabbit hole as I am, I didn't realize that you could put in multiple types of collateral and borrow against all of it. those are high net worth financial services in the traditional world, and that's something that, I think I don't come from that sort of background. I was unaware that you could even do that. And, my friends like you that worked in financial services, were a few of them have laughed at me. They're like, yeah, man, that's normal stuff. And I'm like, that's normal stuff for rich people. That's not normal stuff for normal people.
Right.
And that to me is why DeFi is so interesting, because it's giving some very valuable services that privileged people have enjoyed. And I realize now you can take advantage of that using DeFi.
Let me chime in real quick there, because that's a really good point. And it's not super normal in the traditional markets. It's normal for banks to have reserves of multiple different types of currencies from other countries, to have gold and other things like that in their reserves. It's not normal for you to say you own Tesla and Apple and Amazon stock, and you want to buy this new tech stock or whatever, but you want to margin trade. You can't deposit those stocks and then borrow against them. Like, that's not normal. And that's something that Aave does enable in crypto. And that's something that, like, Synthetics, which is working to kind of, working with Chainlink to develop price feeds and create synthetic representations of real world equities and commodities and everything else. All these kind of protocols working together, and the composability of the space, which is another one of the pitch points that I love to kind of talk about. It's creating this brand new ability to, I have the same exact kind of deposit portfolio that you have. I have Wi-Fi, I have ETH, I have Wrap Bitcoin, I have a bunch of Link, I have Lend, even things that I'm not necessarily earning a great yield on in Aave that could be earning greater yields elsewhere, like Wire or Cream, but still it allows me to borrow against them. So, and
yeah, it's really, it is a light bulb moment for many of us. And I was just showing here Yearn.finance, because at the end of the day, the fact that you talked about, like, if I have Google or Apple stock, it's not like I can go trade with that unless I literally am just buying or selling the security. But in DeFi, it's different. Like, these are all assets that I can potentially put to work. And I think the one that like even here that's most striking is the fact that I'm earning, let's say, with stable coins with the Curve Y pool, but then that liquidity, the claim on the liquidity, is what I'm using here to earn more. So that's why this is such a popular product. And if you go to Zapper.fi/invest and just search Yearn, it stands for you earn. You can take a look at all the different vaults there. Keegan, I wanted to ask you though more about. Oh yeah, go ahead. Yeah.
I wanted to give a shout out to Zapper. There's been I'm pretty much degen, very deep in the DeFi space. It's kind of, I think I probably hear about things like probably within a couple hours when they come out typically, because I'm just like so glued to my phone and all the different Telegram and Discords and crypto Twitter and all that stuff. But there's been a couple times where I've like looked at my Zapper and I've gone on just like the invest tab in Zapper, and I'll see that I have some things that like aren't even staked, and I'm like, what the hell? How am I not even maximizing kind of the yield that I'm generating on some of these assets? So huge shout out. So like you just saw like the stake button there. Huge shout out to Zapper for that. And kind of on that same thread, huge shout out to Synthetics for, all their LP rewards. They kind of like, Kane's kind of like the father of modern agriculture or yield farming. But he also is kind of the father of like composability, in the sense that he made me a Curve LP, a Balancer LP, a Uniswap LP, by adding those rewards. And now this is commonplace. You see, like, I was farming like a sushi kimchi pool like 2 weeks ago or whenever that was, before that blew up. So I think that that composability is really cool, and huge shout outs to kind of Zapper for making sure that you're always earning your maximum yield. Wire on kind of the same thread, and Synthetics for kind of kicking off this whole thing in the beginning.
I gotta send you all that ether I promised you. So thank you. It is. It's part of.
It was 1 million for the record, right? 1 million.
Yeah, it was 1 million. Yeah, 1 million ether. Just gonna send you 1% of what I have. Actually, before we move on to another topic, there was just a really simple question here from Webby. Can you post a URL for the guest project? Do you guys have a website for Fourth Revolution Capital yet?
We do. It's in stealth mode. So we'll announce everything once we're done with our raise. Kind of the attorneys are being very strict on kind of what we can share publicly and like post on Twitter and everything right now, as we don't want to be kind of.
I don't know. Makes sense. Yeah, we don't want you to go to jail. We need.
Unfortunately, there's all these cool new ideas like how to launch a fund, like Farm Bridge, this project that we led the seed round on. Really cool project. I can, they went DAO first, and so we led everything like directly through a DAO. There was like a SAF that was kind of like a paperwork backup and stuff, but that we would love to go that route and kind of avoid some of the traditional kind of regulation around funds, but unfortunately we're not quite there yet. So stay tuned for more details on the fund. We'll have a website and we'll have a Medium post, and we'll have a lot of kind of outlining the strategies and kind of passive income strategies and everything. So
yeah, I think this is probably the first of many times that you'll join us. It's very difficult to keep up with everything in DeFi, and I think we want to represent as many new and old voices as possible. But I have struggled to find someone who tracks everything as much as you do. So, Keegan, let's go back to, I failed to share this at the start. We're going to talk another 15 minutes, and then we're going to go into questions. I think we're always going to try to set aside 15 to 30 minutes every Yield TV episode to just answer questions until people yell at me and tell me to stop doing that. So the agenda here was we kind of covered the background of 4RC and yourself. We're starting to talk a little bit more about DeFi fundamentals. I think my next question for you is more to do with, the market is still up a lot from the start of the year. Like the crypto market in general, the DeFi market especially. I don't normally think about DeFi token prices. I'm very fixated on how to use it and be a market participant, provide liquidity, use interest earning mechanisms, especially with stable coins. That all being said, the price affects us. And so the market has drawn down a lot. Some tokens are down 80% already. These were newer, illiquid governance tokens. And I'd say the major market, Ether was up at like, I think a high of like 460 or something maybe, and it's down to like 320. So how do you think about DeFi and being a market participant when there's a drawdown? Like, what opportunities do you try to take advantage of? What's the noise that you try to block out?
Sure. Yeah, so I think now is a great time, when we have these retracements, to get back to like the fundamentals of like, how do you look at token valuation? How can you apply like traditional valuation methodologies to crypto assets? I can't share a lot of kind of the fund strategy, but I did put out a series of Medium articles, and one of them was called Token Valuation Methods. So if you Google the DeFi opportunity, token valuation methods, you'll probably see my name, Keegan Selby, pop up. And I did a whole post there where I talk about kind of fundamental analysis. So that's kind of like long-term with Fourth Revolution Capital. We're not day trading crypto. We're long and hold. So we're buying into projects. We're providing institutional liquidity. We're participating in governance. We're providing marketing and developer resources to build on top of the protocols that we invest in. Kind of shout out to Framework Ventures. They kind of pioneered that network capital model that we lend a lot of our strategy from, or borrow a lot of our strategy from, rather. So when you get into kind of these markets, it's like, hey, like, now that kind of the yam and the sushi and spaghetti money and all that kind of the fleeting 1,000+ APY yield crazes are over, let's see where there's true product that actually has like cash flowing, that's actually revenue flowing, that you can use models like DCF, like PE ratios, like I was talking about earlier, and you can actually evaluate them. And if you use tools like Token Terminal, which does a really good job. Yeah, that's the article right there. So if you use tools like Token Terminal, which does a great job at kind of ranking the revenues, things like DeFi Pulse that give you kind of stats on the different projects, you can actually get to kind of PE ratios, and you can compare things to like your startups in the traditional world. And you can like this Chainlink fundamental analysis. I kind of look at the total addressable market for smart contracts in general, which I think I have a couple, and I have a slide on that in my deck for my fund. That's really interesting. It's like, the DeFi market cap right now is like 14 billion, or it was, whenever I made this slide. Cryptocurrency alone is 360 billion, right? Gold is like 10 trillion. The stock market's like 90 trillion. Real estate, if we can kind of tokenize kind of the new NFT movement, if we can tokenize real estate and do kind of really cool things like fractional ownership and like liquidity for real estate, where I can sell you like 2% of my house, or if I want, without having to take out a mortgage against it. The market, like the derivatives market, which is anywhere from like 700 trillion to like a quadrillion dollars. We're super early. So if you can look at kind of models that capture, that are actually cash flowing and have real usage aside from like people depositing and trading a bunch of BAT on Compound to earn the comp token, but real fundamentals like, synthetics, people that are actually trading synthetic representation of assets, Aave, people that are actually, borrowing in order to do things like speculate now, but one day when they have credit delegation and under-collateralized lending, like Teller, cool projects that are kind of coming out with these new credit scoring on-chain credit scoring, we'll have like real retail use case there. Right now, it's like, let's be honest, people are using Aave to borrow against their assets to, trade on margin or get, use tokens to farm or whatever. But they're not using it to like, to like take out like a small business loan or to fund get a mortgage on their house or anything. And we're building projects that are going to enable that. So if you look at those, if you look at current cash flowing models and you apply like a DCF, that's one way to kind of really find the real value in DeFi. And then if you look at models that enable kind of new use cases that bring us to the full replication of all the traditional financial products on chain, I think those are kind of the two areas that I really focus on when I'm evaluating projects and I'm making investments.
I like want to ask you more about how you think about the market and like the teams that you would like to invest in, but I feel like this show is going to focus more on like actually participating in the DeFi market. So I'll ask you some more obvious questions about what are the DeFi applications that you're using most often right now? Like in light of, again, this market drawdown, like what do you have exposure to in terms of applications? And are there any that you're focusing on more in light of the market being down?
Yeah, sure. Well, this is easy. I can just look at the tabs that I have open on screen right now. First tab open, Zapper. Shout out Zapper.
Zapper, of course. Hey, Keegan, you hold on just a sec.
So visually diluted market cap there is insane. Who knows where that is?
Oh, there you go. Now you're back. Okay, I don't know if it was you or me, but you froze for a sec. You said Zapper. I sent you more ether for that, and now you can keep going.
So all like the automated market makers, DEXs, so Curve, Uniswap, Balancer, MStable, the money market protocols like Aave, Compound, DYDX, and Maker, some of the automated asset managers. I think these are really like the coolest new things for retail. Like if you're new to the space and you're like, shoot, I'm never going to be able to keep up with like, DeFi Dad and all these guys that are super deep in it that are trading. Things like Wiren and like Set, token sets. These allow you to programmatically access the highest interest rates for whatever, or the highest yields. Now we have kind of like programmatic yield farming. So I can kind of explain that really quick. Like Wiren, kind of their kind of APR tool is, if there's a higher rate on Compound than Aave for a specific stablecoin, Wiren can reallocate programmatically your assets, your collateral, to capture that higher yield. And they're doing the same thing with kind of farming now, where they have like a Link vault, where they will take, they'll borrow against Link, they'll borrow stable coins, they'll deposit those stable coins into like a Curve, they'll harvest the Curve governance token, they'll dump it for more Link, and then you'll get yield in Link. So these are all kind of programmatic. They're set and forget strategies, which I always like. I love to kind of recommend those. Trying to compete with like these kind of new crazy, vegetable or food tokens or whatever. A lot of it is fleeting. If you're new to the space, don't focus, don't spend your energy. Don't worry about, I could be making 1,000% over there. Stick to the real the protocols that are set and forget, that have really strong kind of communities behind them. Set was another one that I wanted to shout out. It's awesome. It allows you to kind of follow the best traders in the game, and if you have a favorite trader, you can kind of have your portfolio mirror all the trades that they're making. Another area, kind of like derivatives, like synthetics, insurance, like Nexus Mutual, which I'm sure you'll do another 100 videos on Nexus Mutual since you're a huge fanboy of them, Travis. Options markets like Open, Future Swap, prediction markets, Augur, Oracles, Chainlink. Shout out to Chainlink, big Link Marine, always have been, always will be. Storage indexing, things like IPFS and the graph. I'm kind of like rambling now. Aggregators like
no. These are all really important tools. Like, I think the ones you called out, I just want to highlight again I think that Y vaults are very easy because like you said, you set it and forget it.
Right.
Setting it, forgetting it could be like a month in DeFi. That's a long time.
Yeah. Forget it for 24 hours, unlike the 30 seconds that you have to pay attention to the other.
Yeah. And I think at the end of the day, the way that I think about it for my own portfolio, this isn't financial advice. Don't follow any strategies that I say. I think about what I already have exposure to. So the example you gave was Link. I wish I was a Link whale. I'm not. But if you have Link, like I do, I've lent it to Aave, so I have a Link, and then I can zap it into a Y vault, and it gets used to earn more Aave interest earning Link. So it's like I was earning the interest off Link. I'm maintaining exposure to it. And then there's a third form of potential upside for me. And that's what yield farming is. Unfortunately, like, it gets a bad name because there are some just really stupid projects out there. And we're not gonna name names, but like, there's just some really like short-sighted ideas, while there are really high quality projects that enable you to do powerful things. And I think what we just talked about is one of them. Let's go to Garth's question here. We can start to talk through more questions here as we go, because I think it matters what's on everyone's minds, like what they're asking. How would you answer this? Garth's asking, what if someone was new to the space and has a basic idea of the crypto space? What would you suggest is a good place to start learning about DeFi and how to use my crypto to work for me?
Sure. I'd say, first of all, Bankless is a really cool resource that I use. I listen to all their podcasts. So that's a great place to kind of get in tune and understand kind of the various resources that are at your disposal. In terms of the actual tools, I just named a bunch. But if you go on like resources like DeFi Pulse that kind of rank like the TBL, and those show you kind of the really strong projects that, that have kind of like long-term promise, that people are actually depositing their collateral into those contracts. So they're kind of battle tested and safer, that, the vast majority of them have gone through formal audits. I'd say definitely get a tool like Zapper that allows you to look at your portfolio and make sure that you're capturing all the possible yield you can have from the assets that you own. And it's super easy. You just hit the invest and it'll be like, hey, like, you're not actually staking this. Like I was saying, that's happened to me before. I'm like, oh, hit the stake button, and then boom, now I'm earning even more yield on that asset. So yeah, those are kind of great places to start. Like Bankless, get a Zapper. Get off exchanges, try, download, if you're so new to the space and you don't have MetaMask yet, download kind of a DeFi wallet like MetaMask or like an Argent that kicks you off of centralized exchanges. I'm not like a super maxi about like the not your keys, not your crypto thing. I think there's certain, there's use cases for everything. There's use cases for third-party custodians, for like big family offices and stuff. And there's use cases to have your money on exchanges for various reasons. But there's also the use case of like get a ledger and use MetaMask and actually be your own bank, certainly. So I think that's a pretty good place to start. Bankless, DeFi Pulse, DeFi Dad's tutorials.
Thanks. Yeah, more are coming your way. Yeah, if anyone's looking for free tutorials, you can just go to DeFiDad.com. So that's an easy one. They're just they're all on YouTube. This will redirect you to my personal YouTube channel, aside from what we're doing here now on Yield TV. Let's see here if there's any other questions that have come up. Otherwise, I've got plenty to keep us busy. Let's see. Nothing else so far. Okay, feel free to just chime in with more questions if you've got them. Why don't we talk about what do you think is one DeFi application or opportunity that you take advantage of that less of the market knows about? That more folks like. Let's think about newcomers again. I'm always focused on like those that are new to the space are the ones that we really need to help the most, to educate, to understand the risk. We could even go with that actually, if you want to talk about how do you manage your risk with your portfolio?
Yeah, I think risk is a really good thing to talk about. I mean, when you're new to the space, there's all sorts of risks here, and they really shouldn't be taken lightly. A lot of people, it's kind of like a meme now where you get like some of the most respected people like Andre in the space that say like they test and or they code in prod. And that's, and you know, they mean that. Like these protocols, they're not regulated to the point where they have to go through significant audits. Anybody in the world can go in there and dump a bunch of money in and then pull the rug on you. So there's, you know, groups, people that are new that aren't aware of like kind of the pump and dump kind of scheme. There's groups that are out there, and that kind of like made its waves like, you know, in the last day or so in crypto Twitter, which don't need to get into that. And I'm not even really trying to, you know, say, oh, shame on those guys anyways.
You can, well, you know what, actually, I mean, it was just brought up, like, why don't you explain what that is in case anyone's not understanding what it is? Because I think there's a lesson to take away from it. It's, you know, being careful about your words and realizing that, you know, that if you, why don't you explain what happened and then we can talk about it.
Sure. So there's a great guy by the name of Anthony Sana in the space. We don't need to spend a ton of time, but you know, there's all these groups of kind of core Ethereum kind of community members that have been around since the get-go, and they always, you know, we always find ourselves in kind of different Telegram channels and Discord groups and coming up with different ideas. And every now and then, kind of like somebody commented like, oh, like, you know, have Jordan on and talk about meme. I listened to his kind of Bankless episode, and this is exactly how meme started too. It was just, you know, it was just a Telegram chat, and they were messing around, talking about different ideas, and then it turns into something greater where, you know, the barrier to minting a new ERC20 token is so low. It's, you know, dollars in 5 minutes. So anyone can just create one of these at any time. This isn't like, oh, hey, you know, if something hits the New York Stock Exchange, then, you know, maybe it's like worth considering investing because it's gone through at least the diligence of making it that far. Just because there's a token for something absolutely in zero way means that it's investable or that it should even consider investing in it. And then there's all these kind of like, there's, you know, actual pump and dump scams where people are like, hey, let's mint this new token. Let's build this big community around it. Let's do some like Ponzi-nomic scheme to get a bunch of people buying it, and let's pull the rug out from everybody and sell it and dump it and have all these people lose 99% of their value that was in that token. And then people, now there's kind of memes around it where it's like, oh, hey, like let's find people to dump on. And that was kind of the poor word choice that Anthony had. And it was a joke, you know, like people like DGen Spartan, who's an anonymous guy on crypto Twitter that I love and I talk to all the time. He says like literally once a day, he's like, oh, I'm going to dump on you guys. I'm going to dump on you guys. And it's funny. And these anonymous guys, you know, they don't catch any rap for it because they're anonymous by nature. And then somebody who's like a respected community figure makes the same joke and it's taken super literally. And, you know, it's all this mayhem. So yeah, definitely let's be careful about our words. Jokes, you know, when you type a joke out on Twitter, anybody can interpret it any way they want. They don't know you're joking. But you know, kind of back to the risks, I think let's talk about kind of how to manage those risks. One is, like I was saying, look at projects that, you know, if you find like a super low market cap token that somebody is telling you from some channel somewhere that, hey, you know, like this is going up 10x and buy it now and blah, 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 it's secret pre-sale, whatever. That's a huge red flag. Probably don't even touch that. Probably block that person immediately, right? No one's trying to give, like leaking alpha is already like, you know, people are, I get in trouble for leaking alpha all the time. No one's messaging you about out of the blue randomly that there's this 10x token that they really want to share this wealth with you. So obviously that's a scam. smart contract risk is probably the biggest risk. That's, you know, not like direct, like scammy, like no one's like really trying to screw you, or they could be, you know, there could be kind of, they have kind of the admin keys and, you know, maybe they're going to just print it and dilute you out. But for the most part, like real protocols that have been around for a while, there could still be smart contract risk. And if you go to a platform like Nexus Mutual, you can actually buy coverage on the smart contract. So in the event that there's a vulnerability in the code, and you lose that collateral that you've put into whatever staking contract or whatever, or like an Aave, then you can get your money back. So kind of things that have been audited, things that have been battle tested are pretty good signs. Things that have been around for, you know, more than 24 hours, and that have a lot of TVL, like on DeFi Pulse, those are relatively safe places to put your money. And if you still want to be even more risk averse, then you can buy coverage on top of it. As far as like kind of the asset class in general, unfortunately, we're still kind of correlated to the traditional equity market. I wish we weren't. It makes nothing but sense not to be. Like you would think that, hey, you know, if you want to be inoculated against inflation from the Fed, money printer, go Burr, printing trillions of dollars, I write about this as well, then, you know, buy something where you can actually audit and participate in the governance of the monetary policy around. Unfortunately, in a fire sale, people panic and sell everything. We're seeing crypto tank whenever the stock market tanks. So unfortunately, we don't have that kind of inverse correlation that I and a lot of people wish that we did. But there's always that, you know, the whole asset class could tank, and it could be for reasons completely outside of crypto. And then there's the kind of like the regulatory risk in general. And that's when it's kind of good to invest in like fully decentralized projects, or at least projects that have a roadmap to decentralization, projects that are talking about handing over governance to a community through a DAO, a decentralized autonomous organization. I'd say those are the big risks, and kind of how I approach them, how I see them, and how I recommend kind of new people to the market to interact and kind of mitigate them.
Yeah, it takes time too. You just gotta what you just mentioned. It comes a lot from experience. I definitely years ago couldn't have rattled off to you all the risks that I'm exposed to in crypto and Ethereum and DeFi, but now it's natural because I've even experienced some of the repercussions, you know, of some of those risks. Quick question, Ferdinand asked, you mentioned this, it's a term that gets used all the time. What does leaking alpha mean?
So alpha in general, like if you just Google it, it essentially means like just a return that's greater than whatever like the benchmark is. So you're outperforming the market. And leaking alpha is like kind of a crypto, it's not just crypto, but it's really popular in crypto when people are saying like, oh, there's this brand new token that's going to be launched, or like Uniswap is going to drop their token, or there's a new yield farming, you know, liquidity mining program that's going to go live. And so leaking alpha is just kind of sharing kind of like investment advice, if you will, which obviously nothing that you heard today is investment advice. This is all for entertainment purposes only. But it's just kind of sharing early investment advice where you think that, you know, there's a big opportunity, and then people that are in that investment are trying to accumulate that token, or trying to capture all that yield themselves and don't want other people coming in to capture like the 1,000% APY that's on this new liquidity mining incentive. They're saying like, don't leak alpha, don't tell anybody about it, because we want that, you know, we want to capture that ourselves.
Yeah, it's a term that also gets misused. I can guarantee that most of the people who are saying that they're leaking alpha are full of shit. You know? So it's if they were leaking alpha all the time, they'd be very, very wealthy, and they wouldn't be tweeting on Twitter at a bunch of anonymous accounts. So yeah, some of it's like a clever way of saying I know something no one else knows that you could financially benefit from. So be aware, everyone. Just saying, like, it's like another sort of risk. There's a lot of, you know, at the end of the day, like when someone is tweeting incessantly about the same stuff over and over again, you can guarantee they probably have some sort of exposure to that, you know, to that token. And, you know, at the end of the day, that is good to be aware of, because I know that while the ideas could be compelling and maybe they're new ideas, you know, I'm very careful and think about, like, what else do I know about this token? What else do I know about this team? I think one of the risks you called out, I really want to like reinforce is and this is what worried me with the food-fi tokens. When you are asking people to provide liquidity, let's say on Uniswap, and then take the liquidity provider share or the liquidity provider token and stake it, I mean, it's like you're performing an action and you're basically lending that money then to them. Yeah. If they maintain admin rights to do whatever the hell they want, which most of us are incapable of assessing, most of us can't audit smart contracts.
Right.
Run yourself into a lot of risk, and so there's going to be. This is not over. We're going to continue to see, I think, projects that show up where it's going to look and sound like the greatest DeFi project ever. And it's good to be aware that there are lots of people out there that will try to take advantage of you and me and everyone else. And so when you put money into an application, I mean, I always think to myself, like, could I live without this money? Yeah. Like, that's how I operate. Could I live without this? Would my life continue onward if I were to use this money to lend or to provide liquidity?
Two things are tag on there that you mentioned. One is impermanent loss on Uniswap. If you're not,
let's talk about that. That's a good one. Yeah.
If you're not familiar with the concept of impermanent loss, definitely Google it. Definitely become familiar with it. It essentially means that if one token in a pair either appreciates or depreciates a ton, you could actually, by being a liquidity provider on Uniswap or Balancer or some of these other automated market makers, you can actually suffer some impermanent loss. So that's, I'm not going to get kind of crazy because it's complicated, but that's definitely a risk that you should be aware of. Another thing that you mentioned, kind of, if any of these new kind of farm tokens, if you have to actually buy the token itself and you can't just mine it by just like putting like, you know, Link or USDC or a token that you already have, and so there's really no opportunity cost, or there's opportunity cost, but there's no actually direct cost. Whenever you have to like buy a token, like that should also be a big red flag that immediately goes off in your mind. Like, hey, if I buy a token in order to farm more of this token, but if that token doesn't have value in the first place, then not only am I the tokens that I'm getting from farming could be worthless one day or probably in the near future, like you saw Yam went from having a bunch of value and then going to essentially worthless. But if you have to buy that token, then also the money that you paid for the token is the middle, and you paid ETH that actually is a real, you know, super valuable, like, you know, that's an L1 blockchain. And that's the big daddy of them all. And if you're using your ETH to buy tokens to farm with, that should be a big red flag. And the last thing that I wanted to talk about there, I wanted to quickly plug back to kind of BarnBridge on the topic of the better kind of liquidity mining schemes. So my fund, I actually did a lot of kind of the financial modeling for their token distribution. We're trying to do this super fair DAO first token distribution. It's really cool. We're trying to make all the farming mechanisms super cool, where you're taking stable coins and you don't need to buy the bond token. You're taking stable coins and you're just liquidity mining a single, it's not even a pair. You don't even have the kind of the IL risk on Uniswap for the base layer yield farming incentive. You can just take your USDC. Yeah, this is it. And then if you go to GitHub, you can read the white paper too. And I really encourage you to. But for example, we're just starting with, you can take your USDC and provide it as collateral, and you can farm the bond token, BOND, that's the token for BarnBridge, by doing that alone. We're not asking you to buy the token and then put it up in, you know, there's an increased incentive, like a 2.5x multiplier if you do, which we think is fair because you're taking on all the risks that I just talked about, the impermanent loss, the volatility risk on the bond token itself. But to start, all you have to do is just take your USDC and you put it into the protocol. And by doing that, you're kind of collateralizing this fixed yield bond product that's brand new to Ethereum. It's going to be kind of the first smart bond on Ethereum. It's a really cool concept that my firm 4RC did a lot of kind of the financial structuring around the product. And we brought a lot of our expertise from mortgage-backed securities and kind of the traditional market securitization to build those products. But just those are kind of the projects where you see people that are very upfront, very full disclosure, trying to be as fair as possible, not asking you to spend money on the token to farm it. Those are kind of those are the projects that I think that I would steer people towards.
And I've got a question here from Webby459. What do you guys think about using impermanent loss, IL? That's a common way to abbreviate it. Using impermanent loss to kind of unwind some risk, almost like a half-baked way to automate dollar cost averaging, DCA. And he or she also noted, especially using two tokens that are not that are very different, that have very different price points. Tough one. Can you answer this? I'm not really sure where to start.
Brilliant question. This is like a deeper strategy that I've used personally, so I think this is awesome. You're definitely onto something, Webby 459. So the example that I would give, kind of bring it back to like a real crypto use case that I've done, rather than kind of speaking in abstracts, is Based. So Based.money came out. It was all the craze. They had these super cool graphics and UI, and it was like this postmodern economic game theory currency that was like, it was attempting to kind of be a stable coin, and it's $80 or whatever. So it wasn't, but one of the strategies there, while I was farming Based, and we all, a lot of people that did farm Based made a killing. It was awesome. Shout out to Based. It was amazing. While we were farming it, one of the ways to kind of DCA, like you're saying, is to go back and pull out your base and then either add liquidity back into your into the Uniswap pair that you're using to farm. And by doing that, you're kind of adjusting your cost basis every time, and you're adjusting, and you're capturing, you're offsetting your impermanent loss, so to speak. So that's kind of one. It's kind of complicated, and I probably didn't do a great job explaining it. But whenever you have impermanent loss, kind of the more often that you either add to your basis or you withdraw, you're realizing that impermanent loss. So it's becoming permanent at that point. So that can be used kind of as a tax loss harvesting strategy. It can be used as a DCA, dollar cost averaging strategy. There's a bunch of different ways to look at impermanent loss. And there's a bunch of projects that are kind of tackling and trying to mitigate and reduce slippage, fees, and IL altogether. So the AMM market and that use case is super exciting kind of product class that we're really interested in and we're following closely.
I think you got me, thinking about this more. So we were talking about this yesterday, and I think that impermanent losses, it's one of those ideas in DeFi that people hear over and over again. Very few people seem to like fully understand how it works. And so just remember, everyone, that when I am a market maker, when I put in 50% USDC, 50% Ether, I'm going in at, let's say Ether is like 347 USDC today. If the price of Ether tanks and goes down to like 200, well, the market, it means that the market, more people are they're selling that Ether. And since I am a liquidity provider, I'm on the other end of that market trend. I am now buying Ether as the price is going down. And so, I mean, that's important to note, because I need to prepare myself as a liquidity provider. Is this part of my strategy? Am I okay with the market going down? Do I think the market's even going to go down? Do I think it's going to go up? If it skyrockets, if Ether is skyrocketing in price, I'm selling Ether as we go upwards. And that's where, I keep it as simple as what you were saying. I try to think about, if the market goes down and I'm buying Ether, am I happy buying Ether at lower prices while the market's going down? If the answer is clearly yes, then the strategy might make sense to me. If I'm unhappy with the idea of selling Ether as the market goes upwards, that's something that I have to consider as to whether or not this makes sense to me to participate. So I'm not a big liquidity provider. I participate in like stablecoin pools. I like assets like tokenized Bitcoin. I like it because I remain exposed to the price of Bitcoin, but there are different types of Bitcoin. And the same thing with Ether and like synthetic Ether I used to participate in. So anyways, things to keep
on. There real quick is we're not trying to scare people away from being Uniswap liquidity providers or LPs on any of the AMMs. You just have to understand the ILRs. And so it's super important to read about it, get thoroughly updated on it. And it's not like if it goes down 50%, if you're an ETH and stablecoin pool and it goes down 50%, then your IL is 50% loss. It's much less than that. So just understand it, kind of do your research. But like Travis was saying, there's other ways to kind of be a liquidity provider where you don't have IL, like things like Curve, where now you're capturing like a percentage of the trading fees pro rata based on the amount of liquidity that you're providing in that pool. Places like Synthetics, where now you're exposed to kind of the volatility of the SNX token price, but you don't have kind of impermanent loss. So there's a lot of other places where you can be an LP and you can get LP rewards. And when I say LP, I'm saying liquidity provider that don't have IL, and they have their trade-offs as well. So we're not saying, hey, like don't IL is a deal breaker. Don't ever be an LP on Uniswap. We're just saying understand the risk, look at the trade-offs between kind of things like Curve and other platforms that don't have that risk, and make your judgment call there.
Yeah,
research you are always.
Yeah, absolutely, a really important concept. I hope more people will come to understand. Let's see, Kenrick was asking why the need to traditionally raise capital for a fund rather than recruiting funds in crypto. And then the next comment there was like, Wi-Fi shows you can easily raise capital. What do you think about that, Keegan? Like, we've talked about your forward thinking about like you're trying to use everything DeFi related, but you do still live in a regulated place. Yep. So there are rules that you have to play by. But yeah, how do you think about this?
So why raise? So one, there's a lot of capital that wants to be exposed. So there's a product market fit for raising capital from traditional investors that don't have kind of the 24/7 bandwidth to stay abreast of all the updates in DeFi and all the latest opportunities. And like we foresee, like we model our Excel models are looking at yields by the hour. So we're reallocating capital like constantly. So there's that market for people that have a bunch of money, hear about DeFi, understand the opportunity, understand that we're kind of at the tip of the iceberg of this financial revolution. We're calling it the fourth industrial revolution, or we're not just like the third one was democratizing information to the internet. Now we're decentralizing a lot of the value that's on the internet and using it to kind of provide these financial services to people all over the world. At a fraction of the costs, and kind of return some of the profits from those financial products and services back to the users. So I guess why not only raise money from people in crypto? Because there's people outside of crypto that don't understand that want to join. And I tend to like being kind of a bridge for people in the traditional finance space and just traditional investors.
Mm-hmm.
In general can you still hear me?
I can hear you now. I don't know if it was me or you, but yeah, you sound better now. Yeah, keep going.
But yeah, to your point, you definitely can raise the concept of DAOs and like Wiren kind of paved the way for this new concept of, hey, like you can put together, pool a bunch of collateral really quickly, especially in crypto probably better than anywhere else. It's probably the most efficient way to kind of hyperscale a collateral pool immediately. So yeah, we're looking at new fund structures. Like the V2 of our fund will probably be something that's more DAO driven, where we'll tokenize the fund, and LPs will have if you own 10%, if you invested 10% of the capital that's in the fund, then just like you do in kind of like other LP networks in crypto, then you'll own 10% of our tokenized fund. And you'll be able to vote on the investment strategy and some of the yield farming and passive income strategies. And so yeah, we're definitely interested in that space. It's a little early, just like, it's kind of early for blockchain to be like, hey, we're going to completely revolutionize the entire supply chain and healthcare and identity and all those industries. It's a little early to, kind of go full DAO first fund for us, especially living and working in the United States and not being anonymous. So I hope that answers your question, but super interested in the topic. We're well versed on how it could work, and we're intent on going there one day. This first one is kind of just by the books, traditional digital asset hedge fund.
Yeah, it's well, and also too, I think I've come to recognize as well, like there's a lot of people out there that are interested to get involved. And at the end of the day, we do need much more capital and liquidity in DeFi, I think, for us to be successful. And as much as I kind of live in the grassroots side of DeFi, I don't know. I feel like I've been in a pretty unique position. I just started getting paid all in crypto. I get paid in stable coins. So it's been really cool. Like I haven't really talked about it actually. I really like, but it's getting paid in stable coins is getting paid in DAI. It feels great, but I gotta say it's tough because I still live in a world where like my rent has to be paid with US dollars. So I have to plan ahead. I have to withdraw and go through a centralized fiat on ramp, off ramp, and it's a pain in the ass. Like I wish I could just pay in DAI or pay in something like USDC. So
we're too far, man. It's gonna, that ability to accept those kind of payments is going to be a massive value proposition for traditional companies. So I don't think we're too far away from that future. I'm optimistic.
Absolutely. I don't know if we've got one more question from Alex we could possibly cover, but I don't fully understand it, Alex. If you have any more detail on it, it says bonding curve can solve liquidity problems. I'm just going to very quickly just cover a bonding curve is something that exists in a select few DeFi projects. I think one of the most notable ones is Nexus Mutual. Nexus Mutual provides DeFi insurance, or it's called smart contract cover. The way that the NXM token is priced, the way that it allows someone to own a part of the insurance mutual or to provide DeFi insurance, the way that that token's priced is it's designed to be aligned with the growth really just the growth of Nexus Mutual. So that NXM token, it doesn't matter if you go on Uniswap. First off, you can't buy NXM. It has to be wrapped NXM there. It's not affected by the buying and selling pressure in quite the same way. And so anyways, a bonding curve, which literally looks like this if you look on a graph, except the opposite, I guess, since I'm reversed here. The idea is that again, it's designed to grow as certain like performance indicators are doing better and better for Nexus Mutual. So anyways, long story short, it's another way to align your community, especially with like Nexus. It's to align the community that is buying smart contract cover or DeFi insurance, those that are providing it, and then those who simply want a stake of the mutual, who also should be staking and providing cover, but they don't have to. And so anyways, if you go to nexusmutual.io, they have a token bonding curve thing there that I should have just brought up from the start. But any other questions on that from anyone else? No, and then Alex was saying normal markets, you need two sides and thus more money. Anyways, any other comments on that, Keegan, or any other thoughts on bonding curve?
I mean, there's a ton. Most projects are using some form or another of bonding curves. Like for example, in Aave, like the rates that they're offering for yields are linked to the utilization, and kind of they have some really cool kind of Aavonomics. If you read, highly suggest reading the Aavonomics Medium post to kind of better understand how their kind of interest rates will be readjusted and will be based on kind of the market rates at the time, and the number of factors that go into that other than just kind of the rate curve. So definitely kind of one of the more technical kind of factors in kind of token price that we work with protocols on designing the tokenomics around. So yeah, I mean, I think once again, like if you read kind of through the Barnbridge white paper that we just released, there's a lot of cool info there that you'll probably be into, Alex, if you're a nerdy bonding curve lover.
Yeah. By the way, too, I just want to disclose when I talk about Nexus, I am exposed to the NXM token. So take what I say with a grain of salt. Like I've spent a lot of time researching it, but I think it's always good to know
Full
If I'm complimenting, if I'm complimentary of something or talking about something that excites me, if I have exposure, I just try to disclose that exposure so that you're fully aware. Let's see, Keegan, anything you want to end with? Like anything else that I guess, like, where should folks continue to follow your work? And do you have any, like, I guess, parting thoughts for the DeFi community?
Yeah. I would just say that if you're new to crypto, some of these kind of big retracements, big kind of sell-offs are super scary. If you're kind of a crypto OG, then you've been through the ringer and this is your 200th, 2000th time that you've owned a token that's gone down 30% or whatever in a day overnight. So don't kind of stay strong, have strong hands, invest in the fundamentals. Don't get distracted by the crazy food tokens. Look at values that have real promise, a real use case, real users, a real community that's built around them. This is the perfect storm. We're at the tip of the iceberg, guys. Like DeFi is just, DeFi is at, less than 1% of capturing the total financial kind of market and that whole kind of market share in general. And DeFi is, a tiny percentage of the total use case for smart contracts and distributed ledger tech. So, you're in the right place. If you're here, if you're watching this YouTube live, you've already set yourself up for success. So stay strong. If you need to kind of put yourself in stable coins to kind of manage your volatility, you don't want to lose a bunch of money, you can always use that. You can always use platforms like Synthetics to short, to buy inverse tokens. But other than that, kind of, if you look at every kind of really key indicator, if you look at the users in DeFi, if you look at the total value locked on DeFi Pulse, everything is just parabolic, going, exploding. So stay strong, keep learning, always do your own research, invest in fundamentals. If you want to follow my work, you can follow me at Keegan_Selby on Twitter, Keegs. And I have a bunch of Medium posts that I put out that kind of outline a lot of my kind of theses, the total narrative, passive income strategies, yield farming, token valuation methodologies, the landscape of DeFi in general. And then, and that's where I'll be announcing a lot of stuff about the fund if you're interested in following our progress there. But other than that, thanks for tuning in. It's been a super pleasure to be on DeFi Dad. Love you and always happy to chat.
Dude, yeah, thanks for coming on. Really fun. You definitely make it an easy conversation. There's so much that you have to share. We'll have to have you back for sure. So yeah, everyone, thanks for tuning in. We'll do this tomorrow at hopefully 12 p.m. Eastern, trying to like stick to a schedule daily. I think we'll be doing this Monday, Wednesday, Friday. To be just totally frank, I was just so excited yesterday that we had done episode 1 and I was like, we ought to do episode 2 as soon as possible. So we'll do episode 3 tomorrow. And yeah, just excited to talk more DeFi. And remember, if you come, you can always ask questions in the comments. The goal, I think, is to continue to answer those questions in every show and really make that ample time to just help people learn. One thing I'll leave off here with, someone just asked, any tips or tricks to avoid getting overly taxed while participating in DeFi? I actually just spoke with someone today who is a tax law attorney, if that's the right way to say it. And we're definitely going to do some shows on crypto taxes. Number one thing I just want to call out on this, just because we're kind of out of time today, is if you are yield farming, if I earn a token and the token is priced at $10 when I claim it, so it's from the time that it hits my wallet or I claim it, it is my understanding, this is not tax advice, I'm not a CPA, but like do your own research on this, but it's my understanding that if it's $10, living in the United States, I pay income tax on the $10 per token. Then from that point onward, Token Tax has told me, you should check out Token Tax, they're wonderful. Token Tax told me that it's just like a gain or loss from there. So if the price goes from $10 to $100, that's a $90 gain. And if I sell at 100, I pay taxes on the gains of up to 100. If it falls from $10 to $1, and let's pretend it's December 31st, I could harvest that loss sell it at $1, and I now have a $9 loss to acknowledge per token there. But
don't forget about the tax. When you claimed at 10, you still owe tax at that $10 cost basis. So
that's right.
With something that goes to 0, you still owe taxes on it, and now you don't have any value in there. So that's, it could be offset by if you sell it and you have kind of like the loss and your cap gain there, or cap loss rather. But yeah, follow token tax. They're great. And tax strategies in crypto are super complex. Highly recommend using, a tool to track your crypto, and it does a lot of good. It really helps. You just plug in your wallets, and it tells you kind of what were trades and what were sells, and what's taxable events, what are not, and kind of optimizes for you. So
yeah, absolutely. And by the way, we don't have any partnership with Token Tax. So again, I mean it when I say try it. It's been an awesome service. I've used it for I think 3 years now. I definitely was like I was a customer in year 1, whenever that was. So anyways, Keegan, thanks so much for joining. I'm going to play my snappy little video to end it because we're very professional here, and then I'll end the broadcast.